Good
Hi,
morning,
Paul.
Michael.
Good morning. We're two of us talking about you, but it's only good things.
Thank you.
Okay, I prepared some questions for you, and this is the question one. We have introduced Street Capital when we had an interview over the phone on this channel over the phone in June. But now it's we have to use that. Having you in, thank you very much for having. It's a privilege for us to have you here in live in studio. Can you just for the viewers who did not watch our interview in June, can you please again tell something about Street Capital? What's the Street Capital is, and what's the benefit, and what's the benefit for our clients and for our viewers to have Street Capital as a lender on the market?
Certainly, and thank you for having me on your program this morning. Street Capital is one of the largest mortgage lenders in Canada. We have almost $11 billion in mortgages under administration. And our parent company is Counsel Corporation, which is a financial services company listed on the Toronto Stock Exchange. So all of the information with respect to Street Capital is public information. It can be accessed by any customer in the marketplace. Street Capital was launched in 2007 by a group of executives that had worked at a large major institution. We thought we could do a better job of handling the needs of mortgage customers in Canada. And so I think really the benefits of using Street Capital overall are we have access to all three mortgage insurers. So we deal with Canada Mortgage and Housing Corporation, we deal with Genworth, and we deal with Canada Guarantee. Over and above that, I think when you use Street Capital, in particular mortgage brokers, you get very competitive interest rates. Our job is to make sure that you obtain a very attractive interest rate at the time of your first transaction with us, as well as when you renew with us. Combine that with what we believe is great service, I think your mortgage is in good hands with Street.
Yeah, I want to talk about that. I would like to add something, because having you as a company who are on the residential market lenders, lending for the consumers, it's a big advantage for our clients, because it's a competitiveness. You added competitiveness to this market, and no bank, no other financial institution would reduce the rate or just give the clients a better rate if you would not push them with your rate strategy. Am I correct on that, I hope?
Yes, our strategy is very simple. We want to offer the client a very competitive rate up front. So there's none of this negotiation that needs to occur where some of the banks start at a very high interest rate, and then you have to negotiate to get a very attractive interest rate. When you deal with Street Capital through mortgage brokers, we offer you very competitive interest rates right up front. So there's no haggle, there's no pricing negotiation. It's a very competitive rate right up front, as well as at time of renewal. So I think you're absolutely right, Michael. We ensure that we keep the pricing very competitive in the marketplace, and we believe we're a very attractive alternative to the retail banks in Canada because we do offer such competitive interest rates.
That's very good. I have another question, Paul, because having you here in studio is really a privilege for me, for Denys, and for our viewers. And I just want to ask you, before we will discuss your Street Capital mortgage products in great details, let us use your extensive knowledge and experience in the Canadian financial industry and get your perspective on major economic issues of 2012, this year, and the year what's coming 2013. What do you think about major economic and financial issues of these 2 years?
Well, I think as everyone's read in the newspaper, there's been just a tremendous amount of uncertainty around the world. And while there's been predictions over the last few years that interest rates in Canada will rise, we haven't seen those increasing interest rates. And I think for the next few years, at least for the next 2 years, we'll certainly see low interest rates remain in the marketplace, which is a benefit to every consumer in Canada who's taking out a mortgage. I think the most important thing here in Canada to note is that we have a very sound financial system, and that has helped our economy as well as the housing market avoid some of the catastrophes that have occurred around the world. right? If you look at the obviously United States, you look at the UK and other parts of the world, they've seen some significant price corrections, and that has had a direct impact on their overall economy. We've avoided that catastrophe here in Canada, thankfully, because of the overall management and guidance by the government as well as the regulatory bodies. We've been very successful here in Canada by maintaining a very strong economy and avoiding housing collapse.
But let me interrupt you for a second. Did you hear that S&P downgraded the Canadian
six banks?
Yeah, 6 banks, and especially Scotia. I was a little bit surprised. Scotia Bank and National Bank, they downgraded their credit rating this
Thursday, I believe. Yeah, Thursday, Friday. Yeah.
And this is a very sound Canadian banks, but they downgraded their credit rating. That might drive to the, I don't know what about interest rates, but may drive the cost of the borrowing. May just be a little bit. How are you going to be affected also by it?
Well, most of our funding comes from what's called the securitization market, which is the Canada mortgage bond as well as the MBS market. So what we do is we pool our mortgages in like mutual funds. Mm-hmm. So we get thousands of mortgage loans, put it into a pool of mortgages, and sell them to institutional investors. So it certainly will have some impact to us, but I don't think it'll have a dramatic impact in terms of increasing the cost of borrowing or increasing the cost of capital considerably that it'll have a detrimental impact on borrowing costs for Canadians.
That's very good for us because that's very important. Next question about we've seen a lot of tightening of mortgage rules by the government. Mm-hmm. I'm saying tightening. It's automatically tightening a lot of rules, and how is gonna impact the mortgage underwriting, mortgage issuance by street capital, and government in June and July just issued the new mortgage rules, and OSFI. It's also government of Canada issued B20 bill, also tightening the rules. What are we going to do with that?
It's going to have a direct impact on...
it's already done.
It's already had an impact, but I think the real extent of the impact will be seen over the next few years. I believe the Department of Finance and OSFI have taken a long-term perspective. So what I mean by that is they did not want to see housing debt grow at the rate that it has been, and it has been growing at an astronomical rate. Recall a few years ago we had 100% loan to value where the client didn't even have to put a down payment towards a purchase of a home. Plus they were able to take a 40-year amortization. So that puts a borrower at considerable risk, and it puts the Canadian economy at considerable risk. So they had to put measures in place to slow down accessibility to housing to higher risk borrowers. As you well stated, there's been some mortgage insurance rules introduced in the summer, as well as the OSFI B20, and that's made it more difficult for a number of borrowers to access credit. Certainly those people who wanted to refinance their houses, now they're restricted to 80% loan to value. Self-employed borrowers, there's stricter guidelines. Overall qualification is tougher because you're looking at a 25-year amortization for a high ratio borrower as opposed to 30 or 35 or 40. So certainly it's taken its impact on a borrower, but I think overall what we will see, and this is my opinion, we'll see the market adjust. So what I mean by that is that buyers who were perhaps going to buy a $400,000 home might end up buying a $350,000 home. There's still going to be a fair amount of demand based on immigrants here in Canada, as well as first-time home buyers and people who want to move into a larger home. I think they'll just have to adjust their expectations of what house they can afford, but they will still continue to buy. I don't believe we've hit a mortgage cliff, so to speak, where the market's going to end. There'll still be a fair amount of real estate activity and mortgage activity, but it'll be at a slower pace than what we've seen in the past.
That you agree that it's a short-term pain for long-term gain.
Absolutely. I think
you agree with that?
I agree with that perspective. Simply because what we were seeing in terms of our company, mortgage applications coming in, let's look at refinances, for example. Many borrowers were using the ability to refinance their property to make renovations to their home. which is a legitimate purpose. It increases the value of the home, increases their overall equity and net worth. Other borrowers that we were receiving applications from were using it to just consolidate their debt. So they continue to borrow on credit cards and loans and lines of credit, and then they would use their property almost like an ATM machine. Right, so it was just a way to supplement their income and their lifestyle, and that poses, I believe, a risk to the market as well as to themselves if they continue to borrow aggressively and use their house and the equity in their house to support their spending habits.
I'm pretty sure that when you hear self-employed, you know what we're talking about. Yeah, OSFI rules, and they're just drastically reduced the access for mortgage money for self-employed. Do we have any kind of mortgages we can give to people who are self-employed, business for self, who don't have a documented evidence of their income? The client who is asking this question, Alexander, he's saying that I have monthly, I can afford to pay $3,000 monthly, but I don't have a documented evidence of that kind of income I have a chance to spend on my mortgage. How this client can get it? And the client has a good credit.
Right, okay, so very good question. I think with the OSFI B20 guideline changes that were introduced, it certainly restricted access to mortgage funding for self-employed borrowers who could not prove income through traditional methods, and that's had a direct impact on the banks predominantly, who've tightened and restricted guidelines in order to be compliant with OSFI B20. From Street Capital's perspective, what we're working on right now is we're working on a self-employed program, the one that will go to 65% loan to value, and then we'll have another program that'll go to 80% loan to value. So we anticipate that to be available in the marketplace most likely by February or March of 2013, because we believe that segment is underserved, and that's a huge opportunity. Clients who have exceptional credit but have other forms of income that can't be proven through traditional methods still should have an opportunity to obtain a mortgage, because from our perspective it's good credit risk. They still have a substantive amount of equity in their homes with good credit and established businesses, so we'll be able to provide solutions for you in the first quarter of 2013.
And a small question, can they still get an insured mortgage without traditional income confirmation?
They can, but it's been more difficult now, Dennis. The mortgage insurers still have stated income or alternative lending programs. The cost is certainly higher to a borrower because you have to pay the mortgage insurance premium, and they tend to ask more questions or more income validation, like how large is the business, how many employees there are. Perhaps they want to get a sense of what the gross sales overall for the corporation happen to be. In the past, those questions wouldn't have been asked. It would have just been based on the equity and the credit worthiness of the borrower, and the mortgage would have been approved. So it's still available, yes, through mortgage insurers, but it's more difficult now than it was in the past.
It's more expensive. Well, the question from the viewer. First, we can maybe just split in two questions, because first question is regarding your products, and next question about your advice.
Okay.
But okay, having you in the studio is very priceless. Okay, client is having mortgage. We arranged mortgage for the client 2 years ago, and he has a mortgage. He heavily paid down the mortgage, and now he has enough, and property probably went up in the price, and he has enough equity there. Client has a mortgage, and most probably this is the, I don't want to ask a question, but
no, he said it's with Street Capital.
With Street Capital, no, the rate is probably very attractive. He wants to increase his mortgage, but he does not want, he wants to take out equity of his mortgage, but he doesn't want to break the mortgage because he has very attractive rate.
Okay.
That's the typical situation, by the way. Yeah, and he's asking how to do it, and if it's possible to do it with Street Capital to increase mortgage without paying penalty, without breaking existing mortgage, just to take equity out. And this is the first, if it's possible, without penalty.
Okay, so, okay.
And I'll give a second question because the second question is related to the first. And the second question, because this is like taking out, you just talked about it, refinancing, taking out the equity and investing in something. Investing in something that may generate more money, as far as I understand, for the client.
Right.
First question about your product, if it's possible to to increase the mortgage without paying penalty and keep the same rate.
Okay, so that's an important question because a lot of clients are still continuing to refinance their mortgages. If it's a fixed rate mortgage that you have, we can offer you what's called an increase in blend. And what that means is we'll take your existing mortgage balance, your existing mortgage rate, and then look to see how much extra money you require, take today's current rate, multiply it by that mortgage amount, and blend the two rates so you avoid a penalty. So you'll be able to multiply the rate on your existing mortgage against your mortgage balance, and then we can add the new mortgage amount and the new interest rate and calculate a very competitive offer for you, and you avoid paying penalties. And of course that would be made available through mortgage brokers because we don't deal directly with the clients. We're like an insurance company.
Yeah.
A lot of insurance companies use mortgage brokers. That's the way our business is built. So I think there's definitely a solution for you to avoid paying a penalty by coming to Street Capital and refinancing your mortgage. But do remember that the maximum you can borrow up to is 80% of the value
Yes.
of your home now,
Yeah.
and that's been regulated by the Department of Finance and OSFI.
About the investment, we'll talk about it later. Yeah, Paul, the next question, the next portion of that question is just investment. If it, I'll maybe just do it a little bit broader meaning, yeah, because we hear a lot of from different banks, from different investment companies. Don't pay down your mortgage. Don't pay down your mortgage. If you have some money, just invest them in something investment because today you can pay down mortgage and you're gonna pay save on probably for 3%. But if you invest money, you will get maybe 10%. 10 it's too much. 5%. Yes. Or the other scenario, if take out money, that's what the question of our client. Take out money of your property and invest because you're gonna get a mortgage for 3% and invest your money what you took out from the property and something bringing you 5%. Do you think it makes sense, and if it's possible to do something with your company? That's what the question of the client.
Okay, well, we don't offer what are termed wealth management products. We're just a residential mortgage lender, so we wouldn't be able to provide any options for your borrowers who want to make investments. But in my opinion, if you're able to find an investment that provides you with that type of return, certainly it makes absolute sense. There's a number of options. You can obviously work with your financial advisor, or you could work with your mortgage broker, because mortgage brokers have the ability to offer second mortgages to clients at a very attractive return, and these are safe investments. We're not talking about highly leveraged properties or higher risk properties, but certainly there's a market opportunity for that to work with your mortgage broker and use some of your investment allocation towards private mortgages. I think in terms of paying off debt, my view has always been if you have credit cards and loans where you're paying a substantially high interest rate, you should pay those off first with any equity that you're planning on taking out of your house, but don't re-borrow again, because that's really what a lot of banks encourage you to do, is to continue to borrow, and it creates a significant amount of interest return for them, but it's costing you a tremendous amount over the long term. So our advice always is to pay off unsecured debt and consolidate it into your mortgage, but then don't go out and re-borrow again, because it just becomes a vicious cycle. You never really establish any equity in your house, and that's typically the largest investment any Canadian makes.
Then summarizing your answer, that if you have some kind of debts, take care of your debts first.
High interest debt.
Yes, high
interest debt.
Yeah. Then if you don't have this kind of debts, you can invest money in high high income generating investment programs.
Right, exactly.
The next question, can I?
Please. Can I done?
We're bouncing between Russian and English. Okay, question for you that probably worries all of our viewers. It worries me and Denys too.
Okay.
As a national lender from coast to coast, you have your hand on the pulse of the real estate market in Canada, and particularly what we are interested in, the real estate market of GTA. What do you think? What would be the perspective of the real estate market in next year in Canada and in GTA?
Okay, I think that's a very important question because I'm also a homeowner and I live here in the Greater Toronto Area. What we are seeing is some small price corrections in certain markets, and that's predominantly in the Greater Toronto Area as well as in Vancouver. So we're seeing some lower prices coming in, so I think sellers are becoming a bit more realistic of the value of their home. We're not seeing the price appreciation that we have seen in the past few years. In fact, what's termed by a lot of economists is we're probably in a balanced market, where it's not a seller's market where sellers have the advantage and they can ask whatever price they want, and we're not in a buyer's market where the buyer can offer whatever price and the seller is forced to sell at that price. I think we're in a balanced market, which is a healthy place to be, because we don't want to see rapid increase in overall property value, because typically when you see that in any market, there's a substantive correction in overall price. And we saw that in the late 80s here in Ontario, where there was a substantial price correction. I don't think we're going to see that. I believe going into 2013, we will see a slower real estate market than we've had in the past few years. Overall, mortgage credit has grown by about 10% per annum. I think next year it'll probably be about 5%. So we'll still see a healthy real estate market overall. There's a fair amount of demand in the marketplace for housing, and so we'll see, I think, a very healthy spring market, simply because there's just so much demand in the marketplace for housing, especially here in the Greater Toronto Area. You've got such a large population base. You've got so many immigrants from all parts of the world coming into Toronto, making it home. So I don't see a substantive price correction like some of the economists are predicting, 10 to 20%. I think that's just fear-mongering. I don't believe that's going to happen.
Do you agree with the idea that the real estate is a pocket market? You know what? I just want to differentiate condo market in downtown and probably here in our area, where do we now, north of Toronto, GTA. It should be different. You have to treat them differently.
You do, and I think...
And do you treat them differently? Because I know that some lenders, I know that some lenders, they're just restricted to the access to up to 75% of purchase price for condo market in downtown. Do you do the same, or you don't have?
We don't have those restrictions. In particular, if the client's purchasing the house as their principal, the condo as a principal residence, we don't place those restrictions on the borrower, as perhaps some lenders do. Obviously, we're concerned about the housing market, in particular speculative buying, where there's a tremendous amount of borrowers purchasing it as an investment and then trying to flip it, and I think that's a significant concern overall for the condo market. But I think in the Toronto market in particular, once again, I'll go back to the demand, the immigration, first-time home buyers. It's an entry-level property that's affordable still at this time in Toronto, and in particular, if you work downtown, it's an easy commute, and therefore I think we'll continue to see some reasonable demand for the condo market. But I think it's specific to those who are planning on living in it as their principal residence.
Next question. Okay, we talked about the real estate market, economic situation, and globally here in Canada, but returning to Street Capital.
Okay.
Street Capital Financial, we are often getting a very common question from our borrowers. Is it safe to deal with a mortgage bank? Street Capital Financial, mortgage bank. We say that's like a mortgage bank. Is it safe for our borrowers to deal with? Not the bank at the corner, but the bank who sits on the Yonge Street first and working through the mortgage brokers only.
Okay, very good question. Number one, street capital is lending the money, so that you're not at any risk from that perspective. You're not. We're investing in your home to help
it's
you.
It's your risk, not the borrower's.
So I think that's the number one consideration. I think the second benefit of dealing with street capital, as I discussed earlier, our company is part of Council Corporation, so it's a publicly traded company with all of our financial information being published on a quarterly basis. So if you're worried about the financial strength of street capital, all that information is available through the Toronto Stock Exchange. So you can certainly do your own research and investigation about the stability of street capital. I think from another perspective, you need to look at it from what we've discussed earlier, which is the benefits of these mortgage companies such as Street Capital and working with mortgage brokers is we're able to provide you with very competitive interest rates and very attractive product features, which I don't think the banks necessarily always provide you with. For example, many of the banks offer lower prepayment privileges. We just had a gentleman call in who was talking about how he had paid off his mortgage substantially and now wanted to take equity out of his house. If you are dealing with some of the banks, they only allow you to make 10% prepayment privileges or 15% prepayment privileges. Ours are as high as 20%. The other thing that you need to think about as well when you're dealing with your mortgage is a mortgage broker is going to investigate the product features, and we're talking about penalties in particular. And some of the banks will charge substantially higher penalties to break your mortgage, or when you're trying to do what we're discussing, which is that increase in blend option. They'll take your existing rate on your mortgage, which might be a very attractive interest rate, but when they're looking at the new money that you're trying to borrow, that might be at a substantially higher interest rate than what's currently available in the marketplace. So your blended rate could be significantly higher than if you were dealing with a company such as Street Capital. So I think, from our perspective, we work in the best interests of the borrower. We believe that we need to offer, as we discussed, competition to the banks, and we've been growing significantly since their inception because of our product features and working with professional mortgage brokers.
Question from the borrowers: if the borrower has to renew the mortgage. Mortgage apps you're long enough on the market, and some mortgages are coming to the renewals. How could they do this? How they can do this through us, through mortgage, directly through your servicing department, or they have to go somewhere else? And if they can do themselves, or they have to go back to mortgage brokers, what the situation? How they can do the renewal?
Sure. So when it comes to the end of your term, we would offer you a renewal agreement with a very attractive interest rate. Like as I said earlier, our rates are everyday low rates, so we'd offer you a very competitive interest rate at time of renewal. You have a couple of options available to you. One, you can contact our servicing center and discuss it with them directly, or you can contact your mortgage broker and discuss the terms with your mortgage broker. It's a very simple process. There's no requalification required at time of renewal, whereas if you were to leave Street Capital and go to another company, you'd have to go through the process of having to prove your income and requalify, send in an application along with a credit bureau. So it's a significant amount of effort and work. But dealing with Street Capital directly and with your mortgage broker, you'll be able to obtain a very competitive interest rate at time of renewal, because that's our strategy. Our strategy is when you get a mortgage with us, we want to offer you a very competitive interest rate as well as at time of renewal. We don't offer a posted rate at time of renewal because we know that that's uncompetitive. You can shop the marketplace. A lot of information is available on the internet with respect to interest rates, and our job is really to make it simple for you to do business with us. We don't want it to be a complicated or frustrating experience where you have to negotiate with us as your financial institution. We want to offer you our best rate at the time of the first mortgage as well as at time of renewal.
It's a very general question from
but
one
very
of
short
our
answer,
client, and he is asking, it's nothing to do with the product, because I have a bunch of questions about the products, but it's very interesting to know your opinion. This is just an opinion, yeah. We have economically a financial crisis, and can we get out of this situation with economical problems with the political methods or with the political movements? Only politically, without any kind of involvement, crashes, problems. It's probably more
because of fiscal cliff in
cliff,
states,
yeah.
something like that. Yeah.
If they can get out of that, just making the agreement politically instead of just
Reforming the whole system.
Yeah.
Something.
Alternative to fiscal cliff, that's cliff, a crash, and then get out of that.
Yeah. Well, a friend of mine who's an economist actually told me a funny line. He said, the biggest risk to our economy is politicians. But that notwithstanding, that's just a humorous perspective. I don't believe that we're at any financial risk here. You look at what's happening. The United States is starting to turn its economy around, and that's our major trading partner. So we certainly have a significant opportunity there to strengthen our economy here in Canada. Secondly, you've seen a lot of effort by Prime Minister Harper in terms of negotiating with some of the world's largest economies, such as India as well as China, to increase trade. And we don't have enough trade with those countries because we are very resource rich here in Canada. So we're in a tremendously influential position when it comes to the world market overall. I think our biggest risk globally is obviously what's going to happen in Europe. There's a tremendous amount of uncertainty. I don't think we have all the facts available to us, but I think sometimes when I listen to some of the economists, they tend to scare us. I don't think rates are going up, right? I don't think we're going to see a significant housing correction in the marketplace. Canadians are very financially responsible. Our banking system is still sound and stable, irrespective of the rating agencies.
Yeah.
You compare it to the overall world banking system. We're very sound financial institutions, and you can just look at the profit that some of the banks have been generating in the quarterly results. They're significant. So they're well capitalized and very strong financial institutions. Yes, we've had a tremendous amount of regulation and oversight from the Department of Finance, and in particular from OSFI and mortgage insurer rules, but that's just to slowly, gradually slow down the real estate market, because it's been a very heated real estate market. And for those of you in the Toronto area, you certainly know, if you've bought a house in the last few years, that there were multiple offers on the house, and the house that you wanted sold substantially higher than what you were planning to offer it. If you're in a buying situation, or if you're in a selling situation, you certainly benefited from that appreciation in the property value. But there's always a big risk if property values increase too rapidly. It's not sustainable. It's unhealthy. It impacts the overall affordability in the marketplace. And while we haven't seen interest rate increases, if we did see interest rate increases over the next 5 to 7 years, it could have a significant impact on the average Canadian's affordability of making their mortgage payments, which is an important concern. But going back to, I think the one point I'll make is that we have a very healthy labor market, and that's the driver of the housing market and the mortgage market. If you have a job, you're going to continue to make your mortgage payments. If you lose your job, then
even 0% interest won't help.
It doesn't matter. It doesn't matter
what the interest rate.
Right.
You don't have money to pay off. Yeah. Very fast questions, and I hope save from you with the answers. I'll give you all 3 questions what I want to ask you, because then you can just measure how to do. First, variable rates. The variable rates were very attractive before, now it's not. What do you think about that? Will they come back with more attractive in the future? Hold on for a second. Okay. Next is, sorry, I just want to, you're going to measure how much time you're going to spend on each answer, because we have 1 minute left. 3 years versus 5 years, what would you recommend? And 10 years, you have now 10 years. It's a very interesting, 10 years and very attractive. Previously it was maybe 3 years rate.
Right. So I think, in our opinion, with respect to variable rate mortgages, is that we don't foresee a situation where you'll see prime minus 80 or prime minus 75. That was unprofitable, and that's one of the reasons that those deep discounts on variable rate mortgages are no longer available. In my opinion, fixed rate mortgage is very attractive given how low the interest rates are. You can get a fixed rate mortgage through Northwood at 2.99 for a 5-year term, or you can get a 3-year at 2.75 or a 10-year at 3.89. My advice to everyone who's looking to obtain a mortgage is deal with a mortgage professional, because they'll guide you to what is the right product for your needs.
Thank you very much.